Greetings everyone. The new tax law 2025 has come to stay. In fact, it's already a law, and so we have no choice than to get ready for the new tax regime. Now, if you are seeing this video, it means you are either a subscriber to this page or a follower or a client. But if this is your first time and you are neither any of the above, kindly subscribe or follow us or reach out to us for services concerning accounting and tax matters. Welcome. You're hearing the voice of Emeka Onyeneke, founder and CEO, FinFacts Pro Solutions. So let's look at this most frequently asked question. How would the tax authority determine what is income or not from my bank statement? This question emanates from whenever we are told that the bank authorities can ask for your bank statement to be able to determine what is your actual income for a particular period. And so this question comes up because people are curious to know how would they know what is income and what is not, as many transactions go through the bank, those that are revenue or revenue inflows and those that are not revenue inflows. So how would the tax authority know? Now here is an answer to that. To the tax authorities, all credit or inflows into your bank account are treated as potential income, whether it's from sales, transfers, loans, or deposits. But the burden is on you, the taxpayer, to prove that certain transactions are not income. Though with adequate narration, the tax authority can filter the known income transactions, but they must be proved with documentary evidence. Let's look at this example. If your bank account shows 50 million total inflows in a particular period or year, and you have part of that amount, 20 million, were from loans, 10 million were from internal transfers, and the rest are unexplained or from customers. Now, it is obvious that the unexplained ones, or those from customers, which is a 20 million, is your turnover or your actual revenue inflow, which is subject to tax. The 20 million loan is not taxable. The internal transfers or the inter-account transfers, that is transfer from one bank to another, is not taxable. So are other transactions, like when a third party pays in money to your account for a particular service or thereabout, or to some contractors or some people, clients pay money into your account to help them buy materials, for a particular job. All these things are not taxable, but you have to prove them with documents for the tax authority to accept, even when they know that these kind of transactions are not taxable. But they want you to prove it, but because they may assume that you deliberately make them look like they were such transactions, whereas they are not. So the only way to prove it is by providing documentary evidence. So this is why it is important that you make documentation for every transaction that you are taking as far as your business is concerned. So here are some best practices to the taxpayer to ensure that you are able to provide evidence if the need arises. 1. Do regular monthly bank reconciliation. This is very, very important. During your bank reconciliation, you will be able to identify transactions that are not income to you and prepare or raise a document to that effect. That's one of the importance of carrying out your bank reconciliation. There are certain transactions which you know that are not inflow, that are not revenue inflows. You raise documents for them. 2. Keep loan agreements, receipts, and evidence of capital injection. For loans, you have to ensure that you have your agreement, your loan agreement intact. Also, ensure you have your receipts for certain transactions that went through into your account. And then also evidence of capital injection. Capital injection is when you introduce capital or new cash into your business. Ensure that there is documentary evidence for it. This is why, again, bank reconciliation is important, because it's from bank reconciliation we'll be able to track some of these things. Because during the time of actual transfer, you may not be able to do any narration or any description, but during bank reconciliation, this can be done because you have all the time to identify these transactions and raise documentary evidence for them. 3. Maintain separate business and personal accounts. Don't merge your business and your personal account. Business transaction must be meant for business account only, and personal transactions for personal account. This is very, very important. And lastly, clearly narrate transactions. Always narrate transactions. And again, this is the essence of one of the essence of bank reconciliation, so that when you're doing it, certain transactions that are not properly narrated, you can track them and raise narration on them when you're raising the documentary evidence. For example, loan from XYZ, not just transfer. So you find out that it is advisable these days to make use of check mostly when you are making certain deposits, so as to clearly narrate what they are for, to avoid falling into the traps of the tax authorities. So these are some of the tips to guide you as we prepare for the new tax regime. Kindly follow us if you are watching us or listening to us for the first time. Subscribe and share. For updates and other insights on the new tax law 2025, reach out to us. We'll be glad to provide you with a guide so that come 2026, he won't be taken unawares.